Hi viewers, you are watching Millennium Academy Accounting Hub.
Today I will teach you about the balance sheet. In this video we will learn, what is the balance sheet? How to read balance sheet. Purpose of the balance sheet. A balance sheet is also called a statement of financial position. It is a statement of assets, liabilities, and owner's equity, which shows the financial position of the business on a particular date. Now we analyze the balance sheet of Smart Copy Company. The heading shows the specific date on which assets and liabilities are identified and measured. The company owned three different assets at the close of business on December 31, 2023. The assets were cash, store supplies, and copy equipment. The total dollar amount for these assets was $28,000. It also shows that the liabilities are $8,000. Owner's equity was $20,000. This amount is the difference between assets and liabilities. Notice that the total amounts on the two sides of the balance sheet are equal. In general, the assets of a business are the properties or economic resources owned by the business. The liabilities of a business are its debts to others. Equity is also called net assets, the residual interest in the assets of an entity that remains after deducting its liabilities. The main stakeholders of Smart Copy Company are owner, vendor, client, employees, and government. These stakeholders want to get the information about the financial position of a Smart Copy Company. The balance sheet helps to know about the Smart Copy Company financial health through the amounts of assets it owns and the obligations against such assets. Now we measure the short-term solvency position of the Smart Copy Company through the current ratio and the quick ratio. These are financial metrics used to assess a company's short-term liquidity. The company current assets are $8,000, and total current liabilities are also $8,000. Now we find the current ratio is 1. It indicates that current assets are exactly equal to its current liabilities. If the current ratio is less than 1, this situation indicates that the company is facing challenges to meet its short-term obligations. Quick ratio is 0.625. It indicates that a company has weak short-term liquidity. This means that for every $1 of current liabilities, the company only has $0.625 in highly liquid assets that can be quickly converted to cash.
If you like a video, then please subscribe to our channel and press bell icon for regular updates.